All right. These are setups I want to look for after an impulsive week. If you check this week, there it was an impulsive move upward, and it was a whole lot of pips that started from this weekly fair value gap after the stop on price drive higher. So one of the things I do after an impulsive week that shows a large bullish candle like this, it can be bullish or bearish. So how I'm going to treat this one is because it's bullish, and after such bullish week like this, one of the things I use my Fibonacci retracement to do according to ICT is to place it this way and then mark the 25%. I'm marking the 25% area as where I'm potentially looking for a trade. So in this kind of trade, what I'm looking for is just the eye of the, how will I call it now? The eye of the impulsive bullish candle, this eye here. So after measure my 25%, my target for this trade is the eye, this particular eye created by the impulsive bullish candle. So based on study, based on what ICT has said, 25% or 30% are the areas price will logically want to retrace into after a large impulsive move like this. So I'm looking for price to come into the 25%. So this is a weekly time frame. I cannot just place trade that place and then allow it to come. I'll go down to the daily time frame, the 4 hours time frame, to check for fair value gaps around those areas. I'll be waiting for price there. So going down to the daily time frame, yes, this is the daily time frame, especially this Monday's move. Yes, this is Monday's move here. This was Friday, and the candle of Wednesday, Thursday, and Friday form a fair value gap, and that is around where we have 25% according to principle. That was around there. So there was a fair value gap around there. No, mind you, it's not just one fair value gap you're having. You're having this fair value gap, and we're having this fair value gap. So what price did was actually going into the fair value gap very close to the 25% area. In either case, these two are closer to this 25% area, but this fair value gap was the nearest, and I feel that's why market used this fair value gap. So this is a daily time frame. This is fair value gap. Price entered into it. That was on Monday. Yes, that was yesterday. That was on Monday. So going down to the 4 hours. Yes, this is the 4 hours time frame. You can see the fair value gap. Price retraced into it. After the retracement, we will see vividly that the target, which was last week high, was already formed. The target last week high was already entered into, and that was much of that. So how would we have traded this market successfully? How? So let's check. This is 4 hours. On the day I see maybe a daily fair value gap, I would love to go to the hourly time frame to check probably for a inversion fair value gap or a break of market structure and return into a fair value gap. So on the 1 hour time frame, something was there. So after price had hit the fair value gap, we can obviously see this inversion fair value gap. So price hits it, form an inversion fair value gap on the 1 hour, price retrace into it very little and continue to drive higher. So if we go to the 15 minutes time frame, this is the 15 minutes time frame. We can see that after there was a stop point, price entered into a fair value gap, there was a shoot high. Let's say this is a short-term high that price took out up, and then price retraced here. This was the hourly time, price retraced into this place. That's for the hourly trade. For those that would take trade around 15 minutes time, they would have taken the trade maybe inside this fair value gap. But then we can see that fair value gap was overlapping with the inversion. So price entered into it, and then this gave around very much pips anyway. Very nice amount of movement. Now if I'm to use there's a 2 here, the forecasting to that long position to let's say I take my position. I took my position here. Yes, let's say I took my position there. I want to see the risk to reward ratio, and I said that my yes, now this is it. This is 1:4, almost 1:5. This gave me almost 70 pips. This gave This gave 70 pips in profit. So this kind of trade I love taking. Let's say my stop loss was a little bit beyond the area. So the risk to reward is is 1:4, 4:1. That means I'm going to, it gave very good stuff, 74 pips. So it's a whole lot. I wasn't here to take the trade, but if I had taken it, at least with a 0.5 lot size, that's a whole lot of pips and a whole lot of pips. So I'm loving this. I really love this setup. It's a kind of setup I love to take at any time. It's a kind of setup I love to take at any time. It took like 2 days to flesh out like this. So I think after an impulsive move every Mondays, after an impulsive move, maybe last week there was an impulsive move, and I'm expecting the formation of a fair value gap with this kind of movement. One of the things I would rather want to do is start to find this setup on Mondays after I've measured the 25% gap. 25% level of the bullish move, so to say. So I will not miss this move again. It's going to be one of my best moves ever, and I'm going to anticipate and trade. period.